There is a tax deadline hiding inside the calendar that most retirement articles barely mention. On January 1st, 2026, every individual income tax rate in the United States is scheduled to go up automatically with no vote required because the law that cut them expires. The Tax Cuts and Jobs Act of 2017 sunsets on December 31st, 2025. After that, the old higher rates return by default. According to the Tax Foundation, a middle-income married couple filing jointly could see their effective federal rate climb by 2 to 4 percentage points overnight. That may not sound enormous, but if you're sitting on a traditional IRA or a 401k full of pre-tax dollars you haven't touched yet, it means every dollar you pull out in 2026 is taxed at a higher rate than every dollar you pull out today, unless you plan now. This video explains exactly what's changing, who it hits hardest, and what the window between now and December 31st, 2025 actually makes possible. How the TCJA brackets actually work today. Let's start with where things stand right now, because you need that baseline to understand what's at stake. The Tax Cuts and Jobs Act took effect for the 2018 tax year. It didn't eliminate any brackets, it compressed them. The top rate dropped from 39.6% to 37%. The 33% bracket became 32%. The 28% bracket dropped to 24%. The 25% bracket fell to 22%. And critically for late starters who are in the middle of the income range, the 15% bracket was replaced by a 12% bracket. According to the IRS, for 2025, a married couple filing jointly pays 12% on taxable income between $23,850 and $96,950. They pay 22% on income from $96,951 up to $206,700, and they pay 24% on income from $206,701 up to $394,600. Those thresholds get adjusted for inflation each year. But the rates themselves, 10, 12, 22, 24, 32, 35, 37, are set by statute, and the statute expires in December 2025. If you're a single filer, the numbers are roughly half those thresholds, but the rate structure is identical. Your filing status changes the math significantly, so run your own numbers, but the direction of change applies to everyone. What reverts in 2026 and by how much? Here's what the reversion actually looks like. Under current law, meaning if Congress does nothing, the 12% bracket goes back to 15%. That is a 25% increase in the rate itself. The 22% bracket reverts to 25%. The 24% bracket reverts to 28%. The 32% bracket reverts to 33%. The 35% bracket stays at 35%. And the top rate goes back from 37% to 39.6%. Think about what that means in dollar terms. If you're a married couple with $80,000 in taxable income in 2025, most of that income sits in the 12% bracket. In 2026, the same income sits in the 15% bracket. On the portion above roughly $24,000, that 3-point difference costs you nearly $1,700 more in federal taxes per year without your income changing at all. According to the Tax Policy Center, about 62% of households would see a tax increase if the TCJA provisions expire as scheduled. The standard deduction also shrinks. In 2025, the standard deduction for a married couple filing jointly is $30,000, according to the IRS. Under the pre-TCJA rules, it was roughly half that in today's inflation-adjusted terms. Some estimates put the 2026 post-sunset standard deduction for joint filers at approximately $16,000 to $17,000 once you adjust for the inflation indexing that applied under the old law, though the precise figure depends on how Treasury implements the transition. That deduction change alone pushes more of your income into taxable territory, which stacks on top of the higher rates. I want to be clear about one thing. Congress could extend the TCJA. There are active legislative discussions happening right now. But planning around "Congress will fix it" is not a strategy. The right move is to treat the sunset as real until it isn't. Why pre-tax savings are the hidden exposure. Here's where late starters specifically feel this. If you've been contributing to a traditional 401k or traditional IRA for most of your career, which describes the majority of American retirement savers, you have deferred your tax bill into the future. According to the Investment Company Institute, Americans held $13.60 trillion in IRAs as of year-end 2023, the large majority of it in traditional pre-tax accounts. Every dollar of that is a future taxable event. You never paid income tax on it. You will when you withdraw it. The question is not whether you'll pay tax on that money. You will. The question is which rates you'll pay, today's rates or tomorrow's rates. That's why the TCJA sunset is specifically relevant to pre-tax account holders. If you have a Roth IRA or a Roth 401k, your money is already post-tax. Qualified distributions from a Roth are tax-free. The bracket changes don't touch that money. But if your savings are mostly in traditional accounts, the sunset is a direct hit to your withdrawal math. Required minimum distributions compound this. Under the Secure 2.0 Act, passed in December 2022, the RMD starting age is now 73 for anyone born between 1951 and 1959. It rises to 75 for anyone born in 1960 or later. That means if you're 60 today, you have roughly 15 years before RMDs begin. Those distributions will be taxed at whatever rates exist when you take them. If the TCJA has expired by then, you're paying 2026 rates on every forced distribution. A worked example: Roth conversions before and after the sunset. Let me walk through a real example end to end because the numbers make this concrete. Say you're 58 years old. You're married, filing jointly. Your household has $60,000 in ordinary income, a combination of part-time work and a small pension. You have $300,000 sitting in a traditional IRA. In 2025, your standard deduction is $30,000. That brings your taxable income down to $30,000. Most of that falls in the 12% bracket. Now say you decide to convert $40,000 of your traditional IRA to a Roth IRA in 2025. That $40,000 gets added to your taxable income. Your new taxable income is $70,000. The first roughly $67,000 is taxed at 12%. The remaining $3,000 or so crosses into the 22% bracket. Your blended federal tax on the converted amount is approximately $5,200 to $5,500. Call it roughly 13.5 cents on every converted dollar. Now run the same scenario in 2026, assuming the sunset takes effect. Your standard deduction is now smaller. Let's use $16,500. Your taxable income before the conversion is $43,500. You add the same $40,000 conversion. Taxable income reaches $83,500. But now the 15% bracket tops out lower and you cross into the 25% bracket sooner. Your blended tax on that same $40,000 conversion is closer to $8,000 to $9,000, roughly 20 to 22 cents on the dollar. That's not a rounding error. On a $40,000 conversion, you would pay roughly $2,500 to $3,500 more in federal tax in 2026 than in 2025 on the exact same transaction. Multiply that over several years of planned conversions and the difference compounds quickly. Your specific numbers will vary based on your income, your filing status, and your state tax rate. But the directional math is the same for almost everyone with a large pre-tax balance. The right move, given this math, is to look hard at how much conversion capacity you have in 2025, meaning how much room exists between your current taxable income and the top of the 22% bracket, and use it deliberately. I'm not saying convert everything. I'm saying quantify the window and make a conscious choice rather than letting the deadline pass by default. The edge case that trips people up: IRMAA, and Social Security taxation. Here's where most people stop, and where the planning actually gets interesting. A Roth conversion increases your income in the year you do it. That has two consequences beyond your income tax bracket that a lot of late starters never see coming. The first is IRMAA, the Income-Related Monthly Adjustment Amount. IRMAA is the Medicare premium surcharge that applies when your modified adjusted gross income, or MAGI, exceeds certain thresholds. In 2025, the base Medicare Part B premium is $185 per month. But if your MAGI from 2 years prior exceeded $106,000 as a single filer, or $212,000 as a joint filer, your Part B premium jumps to $259 per month, or higher depending on how far over the threshold you land. The jumps are steep. According to the Centers for Medicare and Medicaid Services, the highest IRMAA tier for Part B reaches $628.90 per month per person in 2025. IRMAA is based on your income from 2 years earlier. So, a large Roth conversion in 2025 can trigger a Medicare premium increase in 2027. If you're converting into Medicare eligibility, that surcharge needs to be factored into the true cost of your conversion. It doesn't make conversions wrong. It makes accurate math essential. The second consequence involves Social Security taxation. Up to 85% of your Social Security benefit is taxable if your combined income, defined as adjusted gross income plus non-taxable interest plus half of your Social Security benefit, exceeds $44,000 for married couples filing jointly, or $34,000 for single filers. These thresholds have not been indexed for inflation since they were set in 1994. According to the Social Security Administration, the majority of Social Security recipients now pay tax on at least a portion of their benefit, because inflation has pushed nearly everyone above those fixed thresholds over the decades. When you do a Roth conversion, that income counts toward combined income. If you're already receiving Social Security, a large conversion in a single year can push more of your benefit into the taxable column. In some cases, an extra dollar of conversion income can cost you more than $1 in combined tax, because it simultaneously raises your bracket and increases the taxable portion of your Social Security. This is sometimes called the Social Security tax torpedo, and it disproportionately affects people with moderate incomes, exactly the late starter audience. I spend my days digging into the rules retirees actually have to live with, and this one surprises people more than almost any other. The IRMAA cliff and the Social Security tax torpedo don't mean you should avoid conversions. They mean you should model your income carefully before deciding on a conversion amount, and do it on a year-by-year basis, not as a one-time exercise. A practical approach: identify the top of your current bracket, subtract your existing income, and treat the remaining space as your conversion ceiling. In 2025, for a married couple with $60,000 in income and a $30,000 standard deduction, that's roughly $37,000 of headroom in the 12% bracket before you hit 22%. Fill that space first. Then decide whether crossing into the 22% bracket is worth it, given what you know about your future RMDs and your expected post-2025 rates. The historical context. Why this happened and what it means. One more piece of context that matters for understanding how seriously to take the sunset. The TCJA was passed through the Senate using a process called budget reconciliation. Reconciliation allows a simple majority rather than the 60 votes normally required to break a filibuster. The trade-off is that reconciliation bills cannot add to the deficit beyond a 10-year window. So, to pass the individual tax cuts with a simple majority in 2017, Congress built in the expiration date. The corporate tax cuts, which dropped the corporate rate from 35% to 21%, were made permanent. The individual cuts were not. That asymmetry was a deliberate legislative choice. This has happened before. The Bush-era tax cuts of 2001 and 2003 known as EGTCRA and JGTRI, were also set to expire. They were extended multiple times before being made partially permanent in the American Taxpayer Relief Act of 2012. The political pattern is cuts expire, Congress scrambles, partial extension follows. But partial is the operative word. In 2012, the top rate did go up. The 39.6% bracket was restored for high earners. The lesson from that episode is that extensions are rarely total, and they rarely come early. They arrive at the last minute, under pressure, and they typically protect lower-income households more than upper-middle-income ones. For a late starter with a $300,000 to $500,000 pre-tax balance, upper middle may describe your future RMD income, even if it doesn't describe your current salary. A 73-year-old with $400,000 in a traditional IRA and a 5% required withdrawal rate is taking out $20,000 per year, on top of Social Security, every year, whether they need it or not. If the TCJA has expired, that income is taxed under the higher pre-2017 schedule. The historical precedent suggests not counting on a full extension. The data is clear. The window between now and December 31st, 2025 is real. It is time-limited, and the cost of ignoring it is measurable in actual dollars. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this framing has been useful, subscribing keeps these videos in your feed. This channel exists specifically for people navigating retirement from behind and looking for evidence-based guidance, not generic advice. What retirement tax question would you like me to dig into next? Drop it in the comments. I read them and build upcoming videos around what this community actually needs to know. Next week, we're looking at one of the most consequential decisions a late starter can make. Taking Social Security at 62, 67, or 70 in 2026. The exact dollar difference between those three dates, and why the inflation picture right now makes the timing decision even harder than it used to be. If you use tax planning software to model your conversions, the link in the description is a tool I've found genuinely useful for running these scenarios. This video may contain affiliate links. I only recommend tools I use personally.